Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are in cold Melbourne for another podcast.
Andrew, I don't know what's going on with the weather, but
It's
not doing what it's meant to be doing at this time of year, and it's freezing. We've got the heater on. We've got the jackets on.
We've got everything.
Absolutely. Anyway, rather than making it a weather podcast, what are we talking to our viewers and our listeners about today?
Yeah, so today we are back again with another market wrap. It's already been another month since the last one, and so we're giving all of our listeners and our viewers a bit of an update around what's been happening in financial markets over the last month or so.
A month already. Time flies when you're having fun.
Absolutely.
Right. So let's kick it off. Andrew, we start in the States like usual.
Yeah, so start in the States. S&P 500 was down 1.17%. Now that's, pretty much a month from the time that we're recording the podcast. So if anyone's fact checking us, then it does mean that it's going to be a little bit off in the time that we record the podcast versus the time that it comes out. There's usually about a week or so delay. But S&P 500 is down a little bit.
Yeah. I guess from a market perspective and interest rates as well too, because this is playing an interesting role in what the markets are doing. But we're seeing that the Fed, in terms of pricing in where rates are going, there's a 94% chance that at the next meeting, or it's not a 94% chance, the calculations is the market's predicting that 94% will stay on hold, whereas the 6% of people conducting this are going to a
rise. Yeah.
Correct. Yeah.
Look, it's an interesting one, and look, we'll come around to it once we start talking about Australia as well. But it seems to be the sentiment from most central banks around the world that the tightening, the rising interest rate environment seems to be. It's definitely slowing down and significantly slowed down. Whether it's come to an end or whether it's something that's potentially even turning in the other direction is yet to be seen. But there's, especially over in the Fed, their next meeting, most economists are really predicting that it's going to be another hold.
Yeah, which is interesting because, we've been talking about this for a while and we're going to use the word soft landing again. So once again, we've been calling...
Although I've heard another one. A lot of economists are now starting to talk about a Goldilocks scenario. That's the other one that started to be drip fed in. We're going to keep it consistent with soft landing.
There seems to be a description or something that comes out of the woodwork for any type of scenario, exactly, right? But what I was going to say is we're talking about a soft landing again, which is great because they're starting to get consensus in the States that we are going to experience a soft landing, meaning that the Fed are going to navigate through this without too much damage and without being unscathed. But what I was going to say is we're talking soft landing again. So, throwing out there to our sponsors or our potential sponsors, I was going to say if you're Qantas, but Qantas has been on the nose a bit recently. So
maybe not.
Maybe not Qantas. Maybe we need to talk to Virgin instead. So Virgin, if you want to jump on the podcast and throw us a plug every time we say soft landing, then we could just insert that at this point in time.
I'm just going to maybe throw this out there. We're not struggling financially. We're perfectly fine. There's nothing wrong with the business. There's nothing wrong with what's going on. I know that Billy's really itching for some sponsorship and really putting it out there for anyone out there. And not to say that it's not what we want, but we're not struggling. It's okay.
We do this out of love, right?
Yeah, exactly right.
That's it. All right, Andrew, bring us back on track.
Yes, bringing us back on track. There is, as Billy was saying, there is a lot more consensus around the possibility of a soft landing. Now, to say that, that's the scenario and, that we're saying go put your money into markets, we've gotten across or we've gotten past the, time where interest rates and inflation are both at peak, which is a pretty scary scenario for financial markets. it would not be prudent to say that. So we're definitely not out of the woodworks. It's just that it is starting to shift in the direction where people are much more optimistic about being able to have navigated all of that. And this is the consensus both in Australia but also across the US as well, is most economists are starting to talk about, we're, getting closer towards the runway, and we've slowed down the speed on our Qantas. No, not Qantas. I don't know who else. Virgin plane.
Say it, Andrew. Soft landing.
Yeah. We're getting closer towards that soft landing scenario.
Yeah, and interestingly enough, we're going to talk about the unemployment data in the US now, which, when we say this, unemployment has risen and it's gone up. Which is not surprising considering that rates go higher and the economy starts to slow down and things. But at least when we talk about it in Australia, there's an optimal rate, believe it or not, there's an optimal rate of the amount of people that are unemployed.
Yeah.
And at the moment we're below that, which naturally you'd think it's a good thing. So there is an optimal rate as well too. So the Fed do target that. So the reason why I'm saying that is when we talk about the next set of data, this is kind of in line with where they're expecting it to go, because it kind of goes just against what we said about things that are looking okay, that they're going to navigate through it unscathed. But what that looks like is the unemployment rate in the US rose by 30 basis points to 3.8%. What that represents is the highest unemployment rate since February of 2022. So essentially, to dissect that, we've seen unemployment rise in the United States.
Which is, I think, for most economists, a good thing.
Yeah.
Obviously not as good for the everyday person or anything like that. But when you're talking about a high inflationary environment, you need people to, not be as employed so that they slow down their spending as a result of it. The difficult scenario in all of this is, and apologies for people that are listening but not actually viewing this, if you kind of imagine that we're bringing down inflation and this is coming down all the way down here, and maybe you've got it to the point where you're close enough that, you want it to just continue horizontally and level out there. The question is, are we actually going to level out and continue that horizontally? Or is that just going to keep going down? Yeah. And the momentum in slowdown is ultimately, the big question in all of this. So you're dealing with inputs in the market that are lagging. So you're putting, inputs into the market by raising rates, and you're not going to see the full result of it for, most economists talk about 12 to 18 months. And so trying to level out something 12 to 18 months in advance and not push it too far is a difficult scenario. And so there's, yet a lot more to be seen, and this soft landing we've got in there is definitely, you can't say that with any degree of confidence. It's just looking like a more likely scenario.
I can hear that sponsorship thing coming in and just playing now for 10 seconds. But, you were right. In terms of the unemployment numbers, you'd think naturally that low unemployment is good for an economy, and it is, don't get me wrong. But if it's too low, what it does is it puts pressure on wages, because as a business owner, you can't get staff. So what you need to do is you need to increase what you're offering in terms of your pay and your reward package, your remuneration package. And then as a consequence of that, you need to lift whatever it is that you're selling, your goods or your services, in order to compensate for that. So it may sound a little bit counterintuitive, but that's kind of how it works. And speaking of these things that have been around that have been inflating the market or distorting where we're at, we're seeing that there's all of the savings that were built up, and this is in the US market, but all of the savings that were built up during COVID because people weren't going out and spending and consuming, about 75% of those savings have now been spent and expunged, which is great because it means that we're starting to get into a more regular position where people don't have these unnatural or artificial amounts of saving that they don't normally have in a normally operating economy.
Yeah, and look, that's also been reflected in some of the data that, spending has actually been a lot hotter than what most economists predicted that it would be. But the fact that 75% of excess savings has now been depleted, again, it's exactly what reserve banks have been trying to do. They've really been trying to, drive that down in order to normalize things, and so that inflation can subsequently come down as a result of it. But again, it's if the price of goods and services stays where it is, even if it doesn't increase with inflation, it is going to put pressure on household budgets as a result of it. And you definitely don't want to see that, savings rate dip below zero and move into, credit card debt and mortgage stress and all of that associated with it as well.
Interesting times to see how this plays out over the next little bit.
Absolutely.
Andrew, moving over to the Australian market.
Yeah, so when we move over to the Australian market, we had ASX 200 dropped by about 2% in the last month. A lot of that was also partly due to some of the volatility that we've seen earnings season. So a lot of the companies are reporting their earnings throughout this period. And as a result, whether they miss target, hit target, or under target is largely going to dictate what their share price is. So you do see some movement and some momentum throughout this that sits out of just the macroeconomic stuff that we're talking about as well.
Yep. And one of the topics that we always love to talk about is interest rates.
Yes.
So Phil Lowe, the outgoing governor of the Reserve Bank, handed down his final interest rate decision.
Last one.
It's his last one ever. And
he could come back.
Well, he could.
I don't know. I think most Australians are pretty upset with him. I don't see that happening, but unlikely, but still possible scenario.
Maybe that's another podcast that we can do, or another episode that we can do where we debate the affirmative and the negative in terms of how well he's performed.
Maybe.
As the governor in his role over the period of the pandemic.
Yeah.
Because I actually think, contrary to popular belief, I actually think he's done an exceptional job with one or two missteps in terms of communication. But anyway, that's another story altogether. So they kept rates on hold.
Yep.
So this is the third consecutive month that they've done that, which is great because they're doing what they say they're going to do, which is looking at the data and making the decision based off what they're seeing from the data sets, the data that they're collecting essentially.
Yeah. Which, look, I think is a bit of a relief to a lot of mortgage holders. The market is now starting to, or when you sort of look at like an RBA rate tracker or anything like that, you're no longer seeing they usually measure a couple of things, and they usually show the likelihood of two scenarios. One, which is a hold, that's always there. But then they're either showing the likelihood of a decline or an increase. Now, throughout the last 12 months, it's always been the likelihood of a hold and the likelihood of an increase. Now it's shifted in the other direction, and it's likelihood of a hold and likelihood of a decline in interest rates. So the market's expecting that, at some point in time in the future, there will be a decline in interest rates. That being said, as you mentioned, the data is really gonna dictate that. And when we do talk about the data, the main or one of the absolute key metrics that they're looking at is inflation. And July inflation was pretty well below expectation. It was at 4.9% in July, and that's down from 5.4% in June. So we are starting to really see that drive down towards the target range. We're not there, but we're heading in the direction of that target 2 to 3% in inflation rate.
Yeah, and one of the things from my perspective is just to call it out, because if you're not used to hearing these numbers and you think 5.4 to 4.9 doesn't sound like a lot, and we get excited that it's heading in the right direction, but you don't want this. If this dropped really, really quickly, then you'd have a problem, because maybe it means that the lever's been pushed too far. So the idea is kind of like a balloon, I guess, in terms of inflating, and the opposite of inflating. I think I need another cup of coffee, but letting the air out, deflating. There we go. Thank you, Andrew. If you deflate too quickly, or if you inflate too quickly, you're going to get issues. So if we see this trajectory continue, I think that's the ultimate in terms of what we want to see coming in, month out, as opposed to dropping from 5.4 back down to 3.4 5 or something like that.
Yeah, and you don't want to see any volatility with it, right? Like they're not wanting to see that drop and increase. You want the slow trajectory towards the target rate.
Well, it makes navigating through this all the more difficult if that was the case. So if the data is jumping around significantly each time it comes out, how do you know what to do next? So this to me, the way that I'm looking at it, seems like whatever we're doing as a central bank, in terms of the jawboning, in terms of the commentary coming out, it's working.
Yeah.
And it just needs to take time. And the other thing, probably just on interest rates as well too, is we have seen a hold, and now they're starting to talk a little bit more about what a decline is going to look like or when a decline is going to happen. But I'm telling people and cautioning people that we're not going to see a decline back down. We're not going to go back down to 2% interest rates here. So you might get 2 or 3 rate cuts just to balance things out a little bit, but I don't think it's going to go back down to, where we were anytime. Well, whether we see it again in our lifetime is another story, but just cautioning people around thinking that, hey, this is maybe the peak of the interest rate cycle, but just be mindful that we're not going back down the same way that we came back up.
Exactly right. Yeah. And if you are, I think the really key thing within all of this, especially when you're talking about individual households, which is really, what we do day in, day out. We obviously talk in this podcast and in this section around, some macroeconomic data, but every day we're talking to, individual clients. We're talking about the impact of all of this to their individual, assets, portfolios, cash flow, all of that stuff. And I think a lot of people are waiting for that decline in order to alleviate the cash flow pressure. And the caution that I throw out there is exactly what you said. The decline is not going to be, unless, we move into a recession and we're now in a period where they need to, spur on the market. But the likely scenario is we're not going to see a decline that's going to come back to, the mortgage rates of 2%.
Yeah.
So you're going to see a slight decline, but it's also going to be something that's going to happen progressively and into the future, not very quickly and in the short term. So if you're waiting for the cash flow pressure release by, just decline in mortgage rates, it's not going to happen. It's not going to happen as substantially as what most people expect it to, and it's not going to be as quick as what most people expect it to. So the thing that I'm trying to get out there is fix the cash flow pressure in other means.
Yeah.
And when that happens, it's going to be a bonus, because waiting for that, I wouldn't be sitting and expecting it.
No, well said. Probably on international news again.
Yeah.
We always like to talk about the US, but I think it's important to call out what's happening in China as well too.
Yeah.
They're one of our major trading partners, so let's call out what's going on over there and talk through how that's having an impact and what that means for our economy.
Yeah, I think one of the big things in China at the moment has been the slowdown in terms of manufacturing, the slowdown in terms of the market, and the impact that the property sector is. I mean, they're having some big reductions in property prices over in China. And so the expectation from really the world has been, okay, what measures are the Chinese government going to put in place in order to spur their economy back up, sort of post coming out of their COVID zero policy and all of that stuff. And it's been one of those things that's been just looming on the sidelines, and everyone's waiting, and we're starting to see that really drip feed through. So there's nothing that's hugely significant, but they have started to announce some easing measures, some quantitative easing in order to support the property sector, the consumption, and also the currency as well. So there's a step in the right direction in order to spur on that economy, but ultimately more is going to be needed if they're really going to push that up as well.
Yeah, and just on the I guess the Chinese story in terms of what's happening there, it's prudent to go back slightly in history and think about their response to COVID. So with China, they took a really hard stance in terms of locking down their population, and as a result, their economy suffered. So once they removed those restrictions, the expectation from, I guess, the rest of the world is that the economy would start kicking and turning over again really quickly, like we've seen in other countries. But that hasn't happened. And the timing of that coincides with what we're seeing in their property sector, where a lot of the larger property developers have started to, not being able to manage the debt obligations that they've got. And as a consequence, they're collapsing and falling over. And that's having an impact on not only the economy, but also on this recovery that everybody's expecting, that China is not kicking off as great as everybody expected. Yeah. The impact that has to us locally, and like I said before, they're one of our major trading partners, but we export a lot of stuff to China, and if their consumption goes down because their economy is not recovering the way that we want, that has a flow-on effect to us here. Yeah. So I just thought it was prudent to call it out, because that's kind of the background story. But for such a large economy, the expectation is that it should be doing more. But you're right, the Chinese government is starting to respond and do a few things to help propel that along, like all governments do. But it's just not, probably a little bit later than what we're expecting, and it was different to what we're expecting to see out of the back of the Chinese recovery.
Yeah, and I think, an interesting thing that you can't forget about as well is that if you consider business and you consider that, you're manufacturing a good, a lot of that was obviously over in China. A lot of manufacturers were, sending that off for, pricing reasons over to China. If your economy has opened up and all of a sudden there's a demand for the goods that you're selling, and China's economy is still chasing a COVID-0 policy, and their manufacturing is not, up to the quantity that you need. Yeah. A lot of companies have shifted their manufacturing to other countries, found other solutions in order to be able to manage that period of time. And the expectation was that it would shift back to China, but it has happened, but not to the degree that that most economies have expected. So it's going to be very interesting as to what the Chinese government does to really spur that on. And look, there is some positive data coming out. I mean, the manufacturing PMI increased to 49.7 in August, and that was its highest reading since March. So manufacturing is really starting to tick along and increase, but it's just not to the expectations of the world, really.
And that could be the demands from countries that are buying goods from China, which is exactly what it is. But wanting to see, a population of 1-point-something billion, wanting to see that really kick off in terms of their own consumption from a local perspective, as well as the demand from the rest of the world buying stuff out of Chinese factories. So, Andrew, well said, well summarised.
Yes, hopefully that's given our listeners a bit more information around, what's been happening in markets around the world and locally as well.
Excellent. Well, Andrew, thank you once again to our listeners and our viewers. We'll catch you on the next one. Like and subscribe, and we'll see you then.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.